So how have you found working from home during this time?
David, I've missed you guys, really. It's, as I keep on saying in my emails to certain people, it's like running 30 different branches of PW Harvey & Co, because we got all our staff all around Port Elizabeth, all set up thanks to Jordan, who's our in-house IT guy. And I must admit, under difficult circumstances, I think that we've managed to cope quite nicely. It's been very interesting to have a look and see the amount of information we've received from the various different organizations we deal with, the different companies such as Allen Gray, Investec, Sun and Liberty, that keep on sending us information, maybe an overkill. But I think that all they're trying to do is give us kind of comfort to know, to tell them that they know what's going on in this market, or to try and give us some kind of confidence that we'll be able to cope under the circumstances. And also it's been interesting that we've been able to really kind of operate on a normal basis, being able to sign documents electronically, open bank accounts, investments, or whatever it may be. And most unfortunately, through this difficult time, we've got 5 deceased estates, and our condolences go to our clients' families under these difficult circumstances.
Yeah, likewise, I've also found that things carry on as normal. There certainly hasn't been a slowdown, and I've been quite surprised at how much work's actually been done, and everyone's buying into the whole process of actually working remotely, which has actually been great.
Yeah, I must admit that modern technology does help. For me, being a little bit older, sometimes it's a bit frustrating. But being able to link up through the, Microsoft Teams and Zoom has been brilliant. And not only that, also the likes of being going onto webinars and listening to some of the economists that we've been most fortunate to listen to has helped us just about making it as good as being back at the office. But it's helped us a lot.
Yeah. All right, Gavin, so moving on, the sort of the impact that this virus has had on globally, what would you say, how does it compare to the 2008 financial crisis for you?
I think, Dave, the biggest thing about 2008 compared to now, this coronavirus, is the fact that in this case, people have lost their lives. And not only that, the fact that it's a worldwide event that has kind of swept right across, whereas the 2008 events kind of was due to the financial difficulties that the Americans found themselves in, which kind of knocked on in terms of the rest of the world. But this has been an incredible setup. And when one thinks of the fact that you've got most countries in a lockdown situation, and when you read articles that like companies in the UK that haven't closed in 155 years through 2 world wars, and suddenly now have to close under this, it's a new ball game. And I think that coming out of this is really which is going to be the interesting thing. For us, it's been interesting to see how the word COVID-19 kind of says that it started at the end of 2019, and that China, what I call the cycle of this whole thing, the Chinese now have gone through this virus and now are back to nearly full production and manufacturing. So it's going to be interesting to see that knock-on effect, and I'm led to believe that a lot of their numbers that they're looking for 2020, they haven't adjusted it to take into consideration the lockdown and the closing up of their factories. Whereas I think the world is going to realize that a lot of businesses will not be able to open. A lot of people are going to lose their jobs, and a lot of retrenchments, a lot of businesses closing down. And I think from that aspect, I think it's going to be a new ball game out there. The interesting thing has been to see how people react and behave, and I use the word. A lot of people, like the sportsmen, are concerned about when they're next going to be playing, and unfortunately haven't taken the humanity side of this whole crisis into consideration. But it certainly caught a lot of people by surprise. And when I read a couple of articles in relation to how a lot of the big institutions around the world kind of anticipated 2020 to be, and none of them discussed anything of a recession. Everyone kind of thought there wouldn't be a bad market, and especially coming out of the strong US market that we had last year, they thought it would kind of continue, maybe not as strong, but continue. And we've now seen what has happened. We've seen the markets come off around about 20 to 30% on it. We have had a bit of a rebound, but we're still thinking there's a little bit to go before we can kind of start thinking about really throwing money into the market.
Yeah, and no one seemed to have been safe during this time. Someone would have felt the effects somewhere along the line, whether it's their pension fund or their jobs.
Yeah, very good point on that. I think a lot of people kind of sweep it underneath the mat. Those that have got pension funds, kind of because they've got no control of it. but I can tell you now their pension fund has taken a knock as well.
And you mentioned, Gavin, the knock-on effect for especially the sporting events, those organisers, stadiums where those families are reliant on that income generated from, say, sales at the cool drinks or stores like that. There's still those effects are still going to be felt throughout the year and maybe even further.
I think so, David. When you start, I just read an article now that they talk about that maybe the Australian Tennis Open, which normally happens in January, they talk about the fact that may be done behind closed doors, and that would be horrific or very sad to see in terms of that. And yeah, I think that all of this kind of leads up to what I call a changed world and what's going to happen going forward from here. From a South African perspective, we must remember that we've also had a situation where we now under junk status, which doesn't have which hasn't added any value to us. We've still got our problem with Eskom and load shedding, which has been forgotten at this stage, but could come back at a later stage. And then for those investors that are looking for returns and have been in cash and have the safe haven of being in cash, the interest rate drop and a further interest rate drop certainly is not fun for those guys.
Yeah, and that actually leads me on to the next question is, what impact does this have on someone who's looking to retire in the next couple of years? Do they have to sort of relook at their financial plan? Do they have to push out retirement?
Yeah, I think we've spoken quite a bit about that already in terms of guys' pension fund or whatever it may be. The problem is that we're all living longer, okay? And as you quite rightly know, we've got one or two clients that are over 100 years old, and our job is to get our clients comfortably to death. I use the word to death, and to start retiring at 65, and to think that one of your spouses could live to 95. That's 30 odd years. So I think that most people need to really seriously think about this retirement when we get into it, and to make a decision about, should I be a consultant, should I look for a mornings only job, or how can I be able to delay my retirement in some possible way. We've also had a double whammy in that most people that are retiring have maybe major two assets, maybe be their house and their pension fund. And we also know that what house prices haven't actually grown in South Africa for the last 10 years and been under major pressure. So that guy looking to retire at the age of 65 and maybe to sell his home for maybe 5 million and maybe buy something small and pocket really 2 million out of that, I think is going to battle a bit to find that 5 million in his property. It's going to be a lot less than that, which is going to be the knock-on effect of his retirement on so on. So not only from the income point of view, but I think from a retirement point of view, one needs to look at what your expenses are to be able to see where one can curtail expenses in terms of trying to make this thing work at the end of the day.
100%. I think from our side, we all know that our inflation or your personal inflation is not exactly what the government or the economists say in South Africa. So to take into account a lower interest rate, you're going to get less income, plus medical aid inflation is going to be a lot higher. People are going to battle for the next while. Okay, Gavin, so in the beginning of the year, we went to a lot of talks with various fund managers and investment houses. And even during this time, we've had a lot of communication sent to us. What has the consensus been between the fund managers during this time?
It's quite interesting, David, because, when one breaks down the unit trust industry, we kind of break it down into kind of 5 sectors. We talk about a one being a money market or income fund, 2 a stable fund. And a stable fund is kind of broken up between what we call 60% in cash and bonds and 40% into equities, both locally and offshore. We then talk about number 3 being a balanced fund, which is the reverse of that, the 60-40, 60 in equities and 40 in cash. And then we talk about number 4 being a pure equity fund, which is in stocks in South Africa. And then number 5 being a specialist fund, be it like a property or an offshore fund or a gold fund or something like that nature. And the fund managers really, all they keep on saying to us that it's about a long-term investment, and to as Cyril, our president, says to us, stay at home. The fund managers are saying to us, stay invested at this stage and don't sit on your hands and don't make a move. It's kind of not easy for us to kind of listen to that, because all of our clients are different stages or phases of their life, and for us to be able to say to a 75-year-old, okay, it's about the long term. It's kind of not the long term. It's about trying to find it. So therefore, when we've invested, as you've seen for the last 3-4 years, most of the new money that we've invested for clients we've been very nervous and cautious about the markets around South Africa, not so much offshore. And our preference has been for the last couple of years has been either income funds or stable or balanced funds in South Africa, and then to send direct money overseas, where we prefer direct offshore investing versus an asset swap in terms of where we. So we in some ways we're fortunate. We have a bit of a protection in the fact that we've been in income funds, and most of my clients as well would have taken advantage of being in a fixed deposit, especially for those over 65 with the first 34,800 Rand of all interest being tax-free. We would have used both husband and wives in terms of doing that. So when we listen to the fund managers, it's horses for courses, and most fund managers are kind of telling us what they want us to hear in terms of backing up their funds. And I've just read an article just now recently where that says here, equity funds and portfolios can protect your wealth in tough times like as now. And I kind of saying, wow, okay, that's quite a big statement to make, because I don't believe that many fund managers have really protected a lot in this difficult time that we've been into it. And a lot of them are saying this knock that came on was so fast that it kind of caught everyone by surprise.
Yeah. So I've also heard the same things, and I understand that they're trying to get us to all stay invested, and for the long term it will be better. But as you're saying, it's very tough for clients to stomach that. I think part of our job is probably to help curb emotions and keep people invested where they can. And then when we'll chat a bit more about a financial plan a bit later, but to ensure they have the correct advice going forward. Gavin, we have chatted a bit about it, but diversification in a client's portfolio or anyone's portfolio, the benefit of diversification is massive. Could you just maybe explain to us where and how we are diversifying for our clients?
Okay, when we talk about diversification, we talk about the different asset classes that one can invest into and have opportunities to invest into. And we talk about a cash, a bond, property, equities, hedge funds, or different asset classes like that. You can go on further when we can talk about gold or antiques or motor cars or vintage motor cars or whatever. But in our case, we fall underneath the SCA, or the Old Financial Services Board, where our job is to manage clients' money that fall underneath those requirements. And we must look and remember that by investing in different asset classes, we're trying to get what we call a real return on our money. And a real return is anything above inflation. And time has shown us over a long period of time that equities have outperformed any other asset classes. I'm talking over a long period of time, 90 odd years in terms of that. So at the moment, cash is kind of king at the moment. And as everyone would always quote in any kind of financial program or anything about Warren Buffett, that always says that in times of crisis like now, it's lovely to have cash and be able to use cash to buy the stocks at low prices in terms of that. So the different asset classes all give different returns. The biggest thing about being diversified is the fact is that when one is dropping, the other one hopefully is going to be able to hold you up. And that's where a little bit of by being in, let's say, a stable fund, that you have access to a large percentage of your money in your stable fund is sitting in cash or bonds, which is kind of protected through this difficult time. It's diversification comes into not only in your own, but to diversify between yourself and your wife or spouse in terms of what it's to be able to have assets to take advantage of these kind of crises. We must also remember that we will experience crises again. I've managed to live through a number of these crises, and at the end of the day, it's about an understanding that they will come again and again and again. And so by being diversified, you're taking protection. The biggest thing about being diversified is where greed comes into it, and where that somebody says to you that I've done exceptionally well by being in the US market and I put all my money in there, I've done exceptionally well. Then you say, well, I've diversified and I haven't done that. I've kind of done average. But that gentleman that's sitting in that fully exposed portfolio to the US would have been smacked quite badly now as we speak at the moment. So diversification comes into it. So it's about understanding that you're not going to shoot the lights out, but when the bad times, you're going to be protected in terms of that.
Yeah. So one of your favorite graphs, and one that we get updated, I think once a year, is that graph that shows us equities versus gold, bonds, cash, and a diversified portfolio over, I think it's 90 years at the moment.
Yeah,
and you can actually see the effect of having a diversified portfolio. It's not at the top, it's not at the bottom, but it smooths out that ride
Correct.
where equities has outperformed, but you can see the big knocks in 2008. Now you can see those effects. Yeah, very important. Gavin, so for people that are invested at the moment, we've obviously seen that there's been quite a big correction or crash, whichever you want to call it at the moment. Do you think clients and individuals' perception of risk will change now after an event like this?
David, we always speak about risk when we discuss a client, and we try and put people into risk profiles. Very difficult for us. I kind of think there are two things with risk. You're either in a non-risk investment, which would be cash and bonds, or you're in a risk investment, which can be a unit trust share, property, whatever it may be. How the risk on the risk side, the variation can vary depending on where you've invested that money into. So for us, it's about understanding what is their expectation, and our job is to try and explain to them and let them understand what we're trying to achieve with them, and that they need to understand if they can stomach the risk, we're going to go that route. Because as we've discussed beforehand, that how equities have outperformed any other asset class going forward. But if a client is looking for 15 to 20% return, we certainly are not being able to do that for them. They need to go elsewhere. But to the expectation of what a risk is and what return you can get is something that we can guide and steer our clients towards.
Sure. And for a client that's maybe a little bit further up the risk spectrum and has that appetite for risk, do you feel that at the moment there's a bit of an opportunity in the markets? Was it too early to say?
I think that from a cyber perspective, we must remember we've had a flat JSE for 5 years. After coming out of the global financial crisis, we came shooting out of there, but then it had been flat. I call it the Zuma years, has been now taken effect. Looking to find opportunities in the market at the moment. A lot of the investment in unit trust companies are saying they prefer local equities versus offshore equities. The biggest thing about offshore equities in terms of if you had cash at the moment to try and buy the offshore equity is the fact that you've got to try and get your money out of the country. And the exchange rate that we've been smacked at the moment is not fun. So you're weighing up of saying, should I get it out at this rate, knowing that I can buy into some of those incredible US companies or companies around the world that have come off on it, and we know will be around in 5 to 10 or 15 years' time. So that is the way up at the moment of saying, what should I do into it? From a local point of view, as you know quite rightly, we haven't, I use the word, built a South African share portfolio for a number of years in the fact that we've been apprehensive about the South African stock market and been nervous about some of the companies. And that word blue chip that a lot of people talk about, it's kind of, when we go through the companies in South Africa, the word blue chip kind of falls away because a lot of the companies we thought were blue chip haven't actually delivered the goods. And we're talking not just 1 year or 2 years, we're talking over a number of period of time. The likes of an MTN that has been really smacked over time, we all thought was a fantastic company in terms of what to do. We were over the moon when they started operating outside of South Africa and looking for other opportunities, but they've been smacked. The likes of Mediclinic, the same story in terms of it. We can go on, a number of those construction companies, a number of the retail companies as well. A company like Famous Brands, one thought it was a great share to have. So we've been very apprehensive about how we build up a South African share portfolio. We've kind of, as you know, geared towards more using the unit trust industry, and we've been more conservative in the unit trust industry. Or we've sent money directly offshore for those clients that can afford to send money overseas and have surplus cash overseas.
Yeah, 100%. I think even the fund managers have been talking about the valuations of SA companies and how they are at the lower end of the spectrum. And this was before this virus hit and there was a bit of a crash. So it's really tough to buy a company at the moment. The uncertainty and the unknown is difficult to stomach. I think one of the graphs that we had a look at this morning or yesterday showed that for South African equities over the last 10 years is now below cash. So something you wouldn't expect from an actor over a period like 10 years, but it just shows how tough it's been, and hopefully it does pick up now, but it speaks volumes.
Yeah. You wonder that if the likes of the interest rate drop will help some of those companies. I don't know, and they talk about a future interest rate drop as well, which would be interesting to see if there's kind of any kind of help for those companies going forward. But I think it's all about At the moment, it's all about the man in the street. Is the man in the street going to have a job after this lockdown period? Because that's the crux of our economy.
Yeah, we need actual growth figures to come through to support economic growth. And Gavin, one other thing, property stocks, they've had a really tough time at the moment. Would you say that's an opportunity, or do you think there's still a lot of headwind for that sector?
I think David, on the property stocks is quite an interesting discussion, because we all know that Edgar's is in a lot of difficulty at the moment, and speaking to some of our clients that deal with Edgar's and listening to them what they've got to say, it's a real sad case out there, and are they going to open up after lockdown? What's going to happen? And it would be a sad day that if Edgar's do close, in the fact that a lot of those property stocks, a lot of the shares have Edgar's as their tenants, and to try and find somebody to fit into that place will be very difficult. We also must remember, I think, that this lockdown has been an interesting exercise, where that I think a lot of companies have found out that they can kind of operate with staff being at home or being somewhere else and not actually in the office. And do we need as much office space going forward? The other thing is that from the property side is that the big side of the property really is the logistics side on it. And I think that if you were going to buy anything in the property, any stocks, you would look at that have got a lot in the logistics sector. But certainly, if you look at the 5, the 3, and the 1 year numbers on the property stocks and unit trust and shares, wow, they've really taken a pounding after being the darlings for a long time.
Yeah, they said I think we went to a presentation recently, they said the property sector seems to lag the rest of the market. So when everyone was running to property and the market is declining, it's now catching up with those things. Yeah, and then leading on, so after everything that we've spoken about, it leads on to my last question: how important is an actual financial plan to make sure you have your diversification in place and the correct risk rating for each client, depending on where they are in their life cycle, if it's starting out, the middle, growth phase, or heading towards retirement?
David, the interesting about PW Harvey & Co, and we've been around for a long time in terms of it, our job is to look after families and people, and we call it ticking the boxes. Do you have enough life cover? Is your disability enough if anything happened to you? What is your retirement like? Have you built up other assets? Is your will in place? Is your medical aid up to date? Have you paid your taxes? And can we help you in the short-term insurance? So having a financial plan, we've created a PW Harvey & Co app, which allows us to be able to put everything together, allows us to be able to access all the clients' information from different organizations, put it all into one statement that we update on a regular basis, or you can pick it up on your phone or your laptop or wherever it may be. The plan is critical in terms of knowing where you're going to go to, and understanding when you can retire and what your capital will be able to generate for you. Because I think that's the biggest thing about it. The people don't understand that R1 million cannot generate what you think it can generate. And our job is to make it real and for the clients to understand what's in their plan. Because when we look at their plan, we can tell them straight away what they have and what they don't have, what's lacking in terms of what we can do to try and help to try and build up that plan. But the plan is obviously once the plan's in place, you have to adapt the plan as you go along in terms of it. Circumstances change or needs change, and be able to do it. But for us, it's all about a financial plan.
Especially to try and see what a client's expectations are as well. What do they expect to get out of their investments? And like you said, R1 million will only give you about 5,000 in income a month. So a bit of education and a bit of input from them as well, something that they need to look at as well, review it with us as financial planners, and make sure we implement and monitor that plan going forward.
Correct. It's about trust in us, and we have the capabilities and the independence and being a Category 2 licensed financial advisor company to be able to, with all of our staff that we have, the different departments that we operate, we can put that plan together in terms of being able to add value for not only for the individual but for the family as well. And we've done that for a number of years, and that's what we enjoy doing in looking after people.
100%. Thanks, Jan.
Thanks, David. Appreciate your time today, and hope to see you soon in the office. Cheers, Aid.